tax switch. So as we end towards the end of the season, this is something that we talked about last week. We are at the end of tax season. So as we look through portfolios, that's what we've been spending the last month on, just looking at the amount of capital gains exposure people have. And so on an individual basis, we have to look at what do we do at this point? Say you have a $50,000 capital gains for this year. We look through different accounts and say, do we have something that's down? And should we be taking that and switching it to something else? Like, for example, in this case, if you have BCE that's down this year and TELUS is down a little bit further this year, maybe you sell, take your tax loss on BCE and buy TELUS from the perspective of you realize those losses, which will help your tax position, but also it doesn't take you out of the whole exposure of the sector because it's likely to recover next year as it's been sold off pretty hard. Both paying good dividends. TELUS looks like maybe they won't cut their dividend. It gives you a chance to make a tax effective switch from one company to another company, similar exposure, but overall help the amount of tax that you're going to pay this year. If you're happy with that positioning, this makes a lot of sense. After 30 days, if you want to switch back from TELUS to BCE, you can do that without negatively affecting your tax exposure as well. So it makes a lot of sense to be thinking about this. If your advisor is not doing that, certainly happy to chat about that at any point. But this is something as our natural course of business. Review current capital gains. Should we reduce by making some tactical switches? I think it makes a lot of sense to consider that in your portfolio at the end of this year, particularly because the markets have done quite well this year.